welcome to TheoTrade. This is Don Kaufman. It's January 27th, 2020, and you are watching the TheoTrade evening video. There are about 8 minutes left inside of today's trading session with the S&Ps down again and another 52 handles right now. We're off just about 1.58% and seeing, well, some fairly extreme sell-side activity inside of today's close. You know, the overwhelming question that just keeps pouring in from the TheoTrade clientele, does, some of this extreme sell-side activity, does this kind of mark the beginning of the end? The beginning of the end of what? Well, of a rally that has been incredibly, persistent since the beginning of October. Now, it's kind of a surprising question to get, obviously, given the fact that, hey, look, net, if we bring up the spiders here, and take a look at let's back up for like the last year and flip this over to percentage terms, just to give you a little bit of perspective. So show prices percentage. I mean, people, we're still only 3% off of the all-time high. And again, that question, though, comes up. Is it the beginning of the end of the beginning? What are we looking at here? And that's precisely what I'm going to try to answer for you in just the next couple of moments. Before I start to dig into the S&Ps, before we look at what's going on inside of the Nasdaq, bigger picture, more important than the S&Ps selling off right now, more important than looking at the volatility futures. We start this evening with the bonds. The bonds, I mentioned this in the weekend video. The bonds, in my opinion, they broke out on Friday. This is just some follow through ultimately today, Monday, and the bonds breaking out to the upside. Why? Why does it matter so much? First of all, it's not just a breakout to the upside. The volume that we're seeing inside of the bond market is, nothing less than magnificent and huge. It's not just about the bonds. It's about the interest rate. The interest rate, of course, that's associated with the bonds, associated with the notes. In this particular case, and I'm just going to close up this left side bar because I'm telling you, this is what matters the most, The 10-year Treasury Index. I talked about it specifically on this weekend's update. We said, you know what? This thing's a stone's throw away from 1.6%, and that is precisely today's trading session where it has gone. We're back down to 1.6%. Why is this, even a topic of my conversation? It's because this is going to be the only topic of conversation in the coming days and coming weeks. If any more sell-side activity, is persistent inside of the S&Ps, and again, in a moment here, I'm going to show you, whether we believe that to be true. But if there's any more sell-side activity, you have to recognize that the yield curve has completely flattened out and is likely to invert again. So we've already seen the Fed turn around in 2019. They lowered rates. They're on the bid in terms of the repo market, right? And nothing that they're going to do, is going to stop, if you will, the inversion of this yield curve. And that changes everything, people, because that changes the entire economic outlook. All of a sudden, we start talking about recession. It's hideous. We are 3% off of the all-time high inside of the S&Ps. We have had 2 down trading sessions, and we're already talking about the yield curve flipping back over. And people, again, they question, is the beginning of the end? I'll tell you what, according to the yield curve, this is not pleasant, This is a very serious move according to the yield curve, a very serious move according to the interest rate, specifically here in the 10-year. Let's dig a little bit deeper than 3% off the all-time high. Let's dig a little bit deeper than the yield curve possibly flipping. Let's get into some very specifics in terms of trade. One of the first ones, one of the hallmarks of sell-side activity would, of course, be volume inside of the S&Ps. The S&Ps are doing about 2.3 million contracts right now with just moments to go into the end of the trading session. However, that is not what I would term the extreme. The reason I bring this up is you look at today's trading session, the S&Ps are down 50. Between you and me, felt like a pretty mellow trading session. Now, some of you might disagree with that, but to me, it felt like a fairly mellow trading session. It's a mellow trading session for the S&Ps having been down effectively 50 points. The other point I'll make with this is the advanced decline line. This is not that kind of quintessential full court press that you typically see on a hideous down day. Again, I don't look at these as being signs of bullish. Okay, that's not a pleasant sign in a day where the S&Ps are off by 1.5%. The advanced decline line, hey, listen, there's actually pockets of strength. Okay, specifically if you start to look at like consumer staples, your Walmarts, right, your Targets, as I'm kind of bringing up on the bottom of the screen over here, these things are actually finishing up today. Okay, need I remind you, in a hideous down day, the kind of day where you're just capitulating underneath your desk, rocking back and forth, there's nowhere to hide. And today, evidently, there are a number of places to hide. There are a couple of, again, as I said, pockets of strength in here. But push that aside for a moment. Let's get into real specifics now. Let's actually look at the SPX, because the SPX, okay, this is where it gets done. This is where hedging activity, okay, is created. And when I say hedging activity is created, every weekend, okay, we talk about the expected move. Now, this expected move, okay, from this past weekend, and I'm going to just go ahead and kind of script it out over here for you. We were anticipating the SPX throughout the course of the week to move up or down, okay, in the amount of what? Okay, $52 up or $52 down. I want you to take a look specifically at the SPX right now, because if you want to know about expected move, and if you want to know what drove trade today, okay, all you have to do is go look at a 1-minute chart specifically in the SPX. What drove trade today? I don't know. How about the fact that they were sitting and riding on the lower edge of the expected move? It's critical, okay? It's absolutely critical, not just for today's trade, but the remainder, okay, of this trading week. Mark this level, people, on your screen, 32.43. 32.43. That is the edge of the expected move. All we're seeing in terms of trade today, we're skirting the edge of the expected move. Nothing more, nothing less. In effect, what that means is, okay, the hedging activity has just driven us literally right on the edge. Now, why is it so important that I know that level for the remainder of the week? Well, if we start to crack outside, even mildly outside of the expected move, okay, by about 5 or 10 points, what this will do is it'll actually kick on a hedging event. Even if it happens in the overnight trade, okay, only seconds to go in the trading day here, it'll kick on a hedging event. Markets will start to sell into selling. Effectively, the more we go down, the more we'll have to actually push us down. It's dynamic hedging, and they'll actually start to accelerate the market to the downside. That can break apart. Things can get ugly. It's no surprise whatsoever, okay, that today we're literally at the bell on the edge of the expected move. If you were not necessarily marking these expected moves on your screen prior to this, okay, rightfully so, you surely are now. The edge of the expected move has held, okay, thus far. That's, again, not necessarily taken per se as a good thing. There's the closing bell. That's not necessarily a good thing. For the most part, the way to look at this, we held it together today. No more, no less. We simply held it together today, but we are closing. For the most part, you're like, oh, it didn't close at the lows. Yeah, you know, we really are kind of closing at session lows. If you take a look at that first print this morning, this was just a kind of the come out trade, and we are a stone's throw off of that. So we are very close to the session lows, and I would anticipate in the next 15 minutes, again, the futures product is open in the next 15 minutes, that we're likely to progress a little bit further down again, clipping possibly into session lows. Not exactly, again, the bright place for us to finish on a trading session. But again, the point that I wanted to make for the entire trading session was, okay, simply put, and I'm reading into some intraday trade here, the volume is not extraordinary inside of the S&Ps. We kind of already made that point. The trade on an intraday basis, as I said, for sell side activity, I mean, come on, you zoom in, okay, to portions of this day, we were doing under 1,000 contracts at portions of today's trading session. That's pretty mellow for a down move, right? And when I say it's like a mellow down move, there's pockets of strength in here. The advanced decline line, okay, it's not exactly like hideous, but it's also not exactly like stellar in here either. And the fact that there are pockets of strength, the fact that the volume is not necessarily in the complete and in the extreme, it leads us to believe, okay, and there's no sense of panic out there. It leads us to believe that when people ask, like, are we near, maybe a short-term bottom? No way, no how. Doesn't feel like it. Now, I'm not saying that we can't bounce and rip from this. Listen, you can't see the news, nor can I, right? And push all the news aside. All you can do, all right, at a point in time like this is justify, your trades based on what you see inside of order flow. I'll tell you a little bit about order flow. As I said, time and again, the financials, okay, they're going to come off hard and fast. They did just that. The financials broke a little bit lower. But today, interestingly enough, there's a lot of traders talking about it's coronavirus, it's this, it's that. Really? Because is the coronavirus really impacting, what? Your Netflix there, which on a percentage basis is getting tagged just as hard as any of the other tech stocks, your Google, right? There are a bunch of stocks that are being punished today for no other reason. They're the top performers. Some of the top performers, okay, are being hammered here. I'll give you another really specific reasoning for this. If you take a look specifically at Intel, which had really stellar earnings, didn't just come off hard today. It came off by 4%, giving back a fairly substantial amount of the returns they made following earnings. Now, I am also more than aware that Apple has its earnings coming out Tuesday after the bell. But I really think at this point in time that you have to kind of push that aside, okay? This is not going to be an easy two-way street moving forward. When I say Apple's earnings, push it aside. If we have another hideous down day, believe me, Apple coming out after the bell could cause a bounce inside of the Nasdaq, but it is not going to be capable of saving the entire marketplace. But you have to look at this as kind of a double-edged sword. Right? So that double-edged sword there is a very, very simple idea. And when I say it's like a kind of a double-edged sword, listen, if Apple beats, right, sure, you may have an opportunity to see a little bit of a rally specifically in the Nasdaq, but Apple is not going to be enough to save the S&Ps. Remember that, because Apple is not going to save the financials. The financials are already getting hammered right now. So good news on Apple after the bell tomorrow. Hey, yeah, it might bid up the Nasdaq a little bit. The dark side of this, if Apple misses, okay, that's when the bonds will explode higher. The yield curve will likely invert. Okay, it is not going to be a happy place if Apple were to miss or not necessarily, hit some of the targets or lower guidance or express any concern whatsoever. It's a dangerous time, okay, that we're in right now. That danger, though, it isn't being driven by Apple. It isn't being driven by equities at all. It's going to be all about the bond market. When some of the fog, okay, of the volatility clears, in the end, what are you left with? Rock bottom interest rates. Rock bottom interest rates are not going to help the financials, okay? You're going to turn around and tell me rock bottom interest rates, that's going to help the home builders. Right now, that's one of the pockets of strength. Okay, take a look over at the XHB. The XHB, it got tagged mildly. Okay, if you take a look at the XHB, the thing's only down like 0.8%. I want you to look at products like this. It's sectors like the XHB. Pockets of strength right now, consider selling into them. Again, consider selling into them. Look at pockets of strength like the XHB and think to yourself, hey, low interest rates, come on, the rates have been low. Now we're going to be talking about not just low interest rates, we're going to be talking about yield curve inversion. Yield curve inversion, that ain't a good thing for the home builders out there. Tremendous amount to think about. As I said, we are very likely to progress, okay, in this next, 10 minutes or so, right pretty much into the session lows. It's ugly out there, people. There's no question. Listen, does some of this extreme, sell side activity, does it kind of mark the beginning of the end? I can't tell you, okay, how deep this cut is going to go. But I can tell you that if the bonds, okay, if they even flinch any more to the upside, the whole conversation in this marketplace changes. The Fed is no longer necessarily going to be your ally, okay? And that's when things can really hit the extreme. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.